Welcome to the Market Update Desk. We're sitting on March 19th. Scott Riley, powered by Mortgage One. We've got some global economic news today, along with some important housing news. So, the Bank of Japan today came out and finally ended their negative interest rate policy and raised rates from 0 to 0.1%. It's the first hike, actually, in 17 years. So their negative interest rate policy has been there for quite a long time. They also ended their yield curve control program. Now, what that was a program to buy their own 10-year Japanese treasury if it rose above a certain level. This is something one would expect actually would be bad for the global markets, but it's actually been well telegraphed and was given well guidance for well ahead of time. And they also gave significant dovish commentary behind it. So the Bank of Japan said they will increase bond buying nimbly if there is a sharp change in rates in the market. So the bond market actually took that as a positive this morning. Now this week is Fed week, and so the Fed is in focus. This is the meeting where the Fed will release their new Statement of Economic Summary projections, which will include the all-important new dot plot and their thoughts on where the economy and employment is going. We expect there's going to be some revisions to some of the Fed members' dot plotting that they had last time to show less rate cuts. The biggest topic of conversation, or that's going to be expected, is going to be regarding the Fed's balance sheet. They've been reducing the balance sheet just about $1.1 trillion a year, but they may begin to start to discuss the reduction of that tapering. They may also be under some pressure to taper the balance sheet due to the depletion in the reserve repo facility, which we've been talking about, which has been contracting the reduction of their balance sheet for them. In order for the Fed to start to cut rates, we really need to see the unemployment rate increase. Some of the technicals that you really want to look for is if the unemployment rate, the U6, gets above 4.2%. And a lot of the projections from Fed members, they've said expect rates, unemployment to get to 4 to 4.1% for 2024. But if it gets to that 4.2% level, we could see a retreat in their focus and their expectation for rate cuts for the year. The unemployment rate rose last period to 3.9% in February, which is significant. Not only is it the highest level we've seen in 2 years, it's now 0.5% above the cycle low back in April 23. Previous times we've seen an unemployment rate rise 0.5% above the cycle. It also pointed to recession, and that happens almost every time. So this is a very important indicator of potential recession. I'm also going to put a graph up that talks about the last times we had that corresponding with recession. So it's a very timely, very accurate indicator of recessions. So housing starts was the great news that we got today. So the builder's information for starts, permits, and completions. So for housing starts, big reversal from January. 10.7% increase month over month to 1.52 million units annually, which is now up 5.9% year over year. Specifically, the important segment of what we're seeing is an increase in single family. That rose 11.6% to a rate of 1.13 million, or an increase of 35% month over month. Single multifamily fell to an annualized rate of approximately 0.39 million. So those are the starts. The permits, which gives us the information for looking forward on inventory, the permits grew 1.9% to 1.52 million annually. That's an increase of 2.4% year over year. Single family, once again, the important sector, rose 1%. So just about half of that, a little over half of the total, grew at 1.03 million for a 29% increase year over year. Completions, those are the homes that just came online for completing. So completions were up 19.7% to 1.73 million annually. That's a 9.6% increase year over year. Single family was up 1.07 million or 20% month over month and 4.2% year over year. This is very important. We saw this huge pipeline of multifamily properties come online and just a huge flow of multifamily units come into the market. What we're likely going to see as those come to completion here in the next 6 to 9 months, we're going to see downward pressure on rents because the availability of units is going to start to get close to a balanced market. That will also help us with inflation numbers, CPI, and personal consumption expenditures, because that shelter cost constitutes so much of those inflation numbers. Technically today, the market's a little bit on edge. We're a little bit of in the green today because of the Bank of Japan's announcement. But tomorrow's the important Fed meeting. And the market's going to be a little bit nervous going into that. That's a 2:00 announcement. I do suspect we'll start out in the red tomorrow as the market starts to absorb information. And once Chair Powell starts to talk about the decision, we all know it's going to be a pause, and then talk about the tapering and talk about potential future rate cuts. Then we'll start to see the market react. Has the Fed telegraphed enough of their intentions where the market takes it and doesn't have huge reactions to it? We'll have to wait and see. We'll keep you updated tomorrow. We appreciate you tuning in.